Some technical traders use theories from way back when, early on in the markets, to help them make trading decisions. One of those traders or theorists was Wyckoff, and our guest today is here to talk about how he uses his theories, Corey Rosenblum. So Corey, who is Wyckoff and why is he important to your trading?
Sure. Well, Richard Wyckoff is an old school technical thinker. So we call him a modern, he's not as popular, let's say, as Charles Dow, or the oldest thinkers in that sense. Schabacker, we know today as Edwards and McGee, that wrote in the 50s of chart patterns. But Wyckoff was in the midst of that thinking. And he was a very influential thinker at the time, and his methods still hold sway today. Really, he built upon Charles Dow's methods of accumulation, and he's most famous for the life cycle, or the general composite investor, looking at that type of methodology in terms of accumulation, where the large institutions are buying when the price is being held down, or there's not a whole lot of price actions going on. That gives way to a rise where Charles Dow called that realization. Wyckoff simply called it markup, when people were coming into the market, buying a stock and accumulating it. Then the final stage was a distribution phase, when institutions were coming out of the market, and let's say the new smaller investors are coming in euphoria when the market's at a new high, but the institutions are distributing. We're looking for divergences, looking for non-confirmations at the highs. And then Wyckoff, that's where actually Charles Dow stopped. It said just distribution. Wyckoff took it a step further and said there is a mark down phase. And really he uses a lot of his work in volume, internals, confirmation, non-confirmation, and purity in the price.
So how do you implement his theories into even short-term trading? I mean, that sounds a little long-term, but you somehow integrate the two together.
Exactly. What I do in my intraday trading is take swing trading methodologies and then interpolate them on the intraday charts. It's a little bit different than what most traders do, just use volume and momentum, say intraday, and take a stock in movement. I'm looking to try to look at confluence levels, look at the holistic picture. So what Wyckoff teaches is price confirmation. At the beginning of any kind of move, there will be a surge in momentum. We call these Wyckoff signs of strength. Or if it's a downside burst, a Wyckoff sign of weakness. In the context of a mature, let's say, at the beginning of an uptrend, the downtrend will be going lower, and there will be an initial sign of strength. We may see a surge higher in volume on what looks on the price chart to be nothing more than a random rally in the context of a downtrend. But if we look behind the scenes, as Wyckoff teaches, at volume, he looked at breadth. We look today at tick, which is the difference in the stocks that are ticking higher or lower as a market internal. And so these kind of things, and momentum also is almost like an impulse or burst. So that can distinguish what is just what to most people seems to be a random upswing and the beginning of a new birth of a new trend. And of course, as that trend matures, we see the opposite. We see non-confirmations toward the end. Could be a 5 or 1 minute chart. And then of course, the end of a signal that kicks to the downside, which is a Wyckoff sign of weakness. New tick low, or new momentum low, or new impulse low on an indicator when the price is not making a corresponding low.
Does Wyckoff do anything to help us with stops, about knowing when we're wrong and when to get out?
Sure. A lot of us looking at the price. He was a tape reader. Wyckoff was actually a tape reader. He's famous for a couple of publications in that. So he uses a lot of price purity. So price, if there's an assumption the price should make a movement in one direction, it should not therefore take out prior lows if it should be going up, let's say. So stop losses should not be placed magically or randomly, but in the places the price should not go. And if that does happen, that should create movement. It should create action and impulse, and maybe in some sense panic on the side of those that were thinking it was going to go in one direction, but it went the opposite. Therefore, the stop loss logic or exit logic when wrong should match the entry logic when correct, when putting on a position. In other words, one should not be spooked out by a random candle.
Corey, thanks for your time.
Thank you, Tim.
You're watching the MoneyShow.com video network.